Underneath the glitter of every golden age lies a quiet truth. Wealth has never been safe. Not in the days of empire, not in the chaos of revolutions, not even in the supposedly stable decades between wars. From the palaces of Babylon to the villas of ancient Rome, the rich have always played a different game than everyone else. They knew that money, whether in gold coins, grain, or land titles, was never just wealth. It was leverage, insurance, and survival. And while ordinary people trusted the system, the elite learned to protect themselves from the system itself. The question is not how they got rich. The real question, the one worth asking today, is how they stayed rich when everything around them was falling apart. To understand this, we need to go back to the earliest examples of concentrated wealth, when rich didn't mean a big bank account, but the ability to control resources no one else could touch. In the city-states of Mesopotamia, 4,000 years before Christ, the wealthiest merchants and rulers didn't just store their silver in vaults. They tied it up in temple loans, farmland leases, and trade monopolies stretching across rivers and deserts. The Sumerian kings, who ruled from cities like Ur and Lagash, kept their wealth safe by entangling it with religion. The temples were not just places of worship, they were the central banks of the ancient world. To seize a temple, assets would be to offend the gods, and that religious shield made elite fortunes politically untouchable. Egyptian pharaohs and their court knew a similar trick. In the Old and Middle Kingdoms, wealth was stored less in coin and more in durable, tangible assets, fertile land along the Nile, warehouses of grain, gold mines in Nubia. These were not easy to confiscate without dismantling the state itself. The ruling elite used an early form of trusts by dedicating properties to temple estates, ensuring they would pass to their heirs even if the central administration shifted. If you were an elite landholder in ancient Egypt, you didn't have to worry much about inflation or currency collapse. Your wealth was in the land, and the land produced food, in a world where food was the ultimate store of value. Fast forward to classical Greece in the 5th century before Christ, and you see a different approach: diversification through mobility. Greek merchants in Athens, Corinth, and the islands of the Aegean made fortunes from maritime trade. They understood that a political coup or a war could erase wealth stored in the city's treasury. So they kept deposits in multiple city-states, invested in cargo ships, and built relationships with bankers in ports as far away as Egypt and the Black Sea. This was an early version of offshore banking, not in secret accounts, but in physical dispersal of assets. If Athens fell to Sparta, a clever merchant could sail to Rhodes and still have enough to start again. Rome took this principle to another level. The Roman elite, senators, generals, and the famously wealthy equestrian class, knew the dangers of political turnover all too well. They saw dictators rise and fall, property confiscations under Sulla and later under Julius Caesar, and entire fortunes wiped out overnight for being on the wrong side of politics. Their solution was a blend of diversification, political insurance, and influence over the financial system itself. The richest Romans did not keep all their wealth in coin. They bought land in multiple provinces, invested in tax farming contracts, and loaned money to foreign kings and cities, knowing repayment would be backed by Roman military power. By holding assets in territories beyond Rome's direct control, they hedged against confiscation at home. Some even moved portable wealth, gold, jewels, artworks, to safe locations far from political rivals. In today's terms, they weren't just diversifying their portfolio, they were diversifying their jurisdictions. During the decline of the Western Roman Empire in the 4th and 5th centuries after Christ, we see a revealing pattern. As the state's ability to enforce order collapsed, elite families shifted wealth from public assets to private hidden ones. Instead of lending money to the imperial treasury, which might never repay, they invested in fortified estates, private armies, and direct trade networks with barbarian tribes. When Rome fell in 476, the imperial treasury was empty, but the richest families still controlled the land, the food supply, and the manpower. The state was gone, but their wealth, protected by centuries of strategic allocation, survived. The medieval world brought new challenges and new tools. In Europe, between the 11th and 15th centuries, the richest merchants and nobles used the church as both a bank and a legal shield. When kings needed money for wars, they often seized assets from their rivals, but property donated to the church in exchange for spiritual benefits was largely untouchable. This meant wealthy families could park assets in monasteries, effectively keeping them safe for later retrieval or management through loyal abbots. The medieval banking families like the Medici in 15th century Florence combined this with an emerging network of bills of exchange, a form of early paper credit, that allowed them to move wealth across borders without carrying gold, which could be stolen. A Medici could be bankrupted in one city and still be rich in another because his capital was stored as ledger entries in distant markets. The Islamic world during its golden age from the 8th to the 13th century also developed sophisticated systems for protecting wealth. Merchants in Baghdad or Cairo used the Hawala system, an informal but trusted network for transferring funds without moving physical money. It relied on personal honor and family reputation, making it incredibly hard for a ruler to seize wealth stored in such a way. The rich could also invest in caravans, real estate, and long-term trade monopolies that would continue producing income even in times of political upheaval. The principle was the same as in Rome and Greece. Spread the risk, move assets out of a single ruler's reach, and keep a portion of wealth invisible to the tax collector. Even in the early modern period, as centralized states grew stronger, the elite continued to adapt. The great merchant families of Venice, Amsterdam, and London in the 16th to 18th centuries learned to tie their fortunes directly to the growth of the state. But in a way that gave them leverage. They bought government debt, supplied ships for naval wars, and provided critical loans in exchange for privileges and exemptions. This made them too valuable to confiscate from. In effect, they turned their wealth into a political shield. Governments might tax the common people into poverty, but the most connected merchants saw their influence and their fortunes grow in every crisis. So what do all these examples tell us? That protecting wealth has always been about two things: control and distance. Control means holding assets that generate value regardless of the political climate, land, trade routes, resources. Distance means making sure those assets are spread across different systems, jurisdictions, and even forms of money, so no single event can erase everything. The rich of ancient times understood something most people still don't. Wealth stored only in the official system is wealth at risk. And that lesson matters today more than ever. We live in an age of instant digital seizure. Governments can freeze bank accounts with a keystroke. Currencies can be devalued overnight. Stock markets can lose a quarter of their value in a week. Inflation can quietly strip away your purchasing power year after year. The ancient elite didn't trust their entire fortune to the state, and neither should you. The tools are different now. International diversification, precious metals, alternative assets, private holdings. But the principle is identical. History doesn't repeat exactly, but the same traps appear again and again. People assume stability is permanent until the day it's not. The wealthy of the past didn't wait for disaster to strike before moving their assets. They acted early, spreading risk and securing long-term value. That's the real meaning of financial freedom. Not just having money, but ensuring it survives the storms. If you take only one lesson from the history of wealth protection, it's this: the system works for those who know how to work around it. The rest? They find out too late that their safe money was never really theirs to control. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look. Underneath the glitter of every golden age lies a quiet truth. Wealth has never been safe. Not in the days of empire, not in the chaos of revolutions, not even in the supposedly stable decades between wars. From the palaces of Babylon to the villas of ancient Rome, the rich have always played a different game than everyone else. They knew that money, whether in gold coins, grain, or land titles, was never just wealth. It was leverage, insurance, and survival. And while ordinary people trusted the system, the elite learned to protect themselves from the system itself. The question is not how they got rich. The real question, the one worth asking today, is how they stayed rich when everything around them was falling apart. To understand this, we need to go back to the earliest examples of concentrated wealth, when rich didn't mean a big bank account